So let's see how many people have joined us right now. We are waiting for more audiences to connect to us. Lives. Okay, sir. So we have our audience joined to us. So now we will be starting a live stream. Good afternoon, esteemed guests, teachers, and my fellow mates. Heartily welcome you to today's webinar. I am Sushipri Sharma, a member of the Inversion Club, and your host for today. As we all are aware about the ongoing pandemic all around the world, and as upcoming finance professionals, we should be well aware about the ongoing activities in the market and the economy. We have been recently discussing a lot about the impact of coronavirus on our economy. We know the stock market is a leading indicator of our economy, but not all segments of the market indicate the same. It is important to discuss and know which instruments have been affected and by how much, and where to invest during these times. Some people are bullish and some people are bearish on the market because people are skeptical on the future of the economy and the impact of the virus on the coming time. We have two experts amongst us whom I am going to introduce to you, and they will share their analysis and discuss about what do they think about the impact of coronavirus on the stock and debt market. I am honored and privileged to introduce you to our speakers for today, Mr. Deven Padhya sir and Mr. Regan Homavazir sir.
Hi.
Mr. Deven Padhya sir. Sir is a director since 2 years at Deve Advisory Services Private Limited. He has also been associated with Darashaw and Company Private Limited as director for the past 21 years. Mr. Deven Padhya sir has also served the Rotaract Club as an international service director for 1 year. Mr. Regan Homavazir sir, CMT and CFTe. Sir is the Vice President and Head of Research and Equity Fund Manager at Darashaw and Company Private Limited since the past 14 years. Now, I would like that I would like to share my screen with Sir. Sir, your presentation.
No, Regan will start first. Regan?
Okay, sir.
Yes, good afternoon, everybody. There are a couple of things that I'd like to speak about, and it's something which is very simple. I'm not going to make it very complicated. I'm going to try and keep it extremely simple so that everybody has a fair idea of what I am thinking. Every fall that has happened in the market, in the stock markets, may it be the 1991 of Harshad Mehta, may it be the 2000 dot-com bubble, may it be the subprime crisis of 2008. There has always been a reason, but if you look into the past, after a very substantial drawdown, which nearly results in about a 60% price destruction on the stock markets, things improve, and they improve dramatically thereafter. The fact is that it does destroy the market by 60%. As far as the current crisis are concerned, we have lost 40% between February and March or mid-April. So in about a month and a half's time, the crisis was so deep that the stock markets have had a historic fall, wherein in under 1 quarter, it lost 40%. Now, this losing 40% has baffled a lot of people. Remember one thing, the reasons are always different, but the price moves in a similar fashion. This time, the price has also moved in not such a similar fashion because it has never in its history fallen 40% in 1 quarter. More importantly, we need to understand a couple of things. Earlier, when the crashes were happening, either it was because of some chori or some scam, or there is a dot-com buzz, or there is something which is extremely inflated in valuation, like the subprime crisis, hyper bullishness. However, this time you had none of those. You never had a scam. You never had hyper bullishness. You never had a reason which was acentric to a company or a sector. It has been a collapse across sectors. This is a real crash. This is a real loss on the economy, because when the subprime crisis had happened, we could all blame Lehman Brothers, we could all blame Bear Stearns, we could all blame a certain financial institution on conduct of which things had gone wrong. This time it has actually gone wrong on every sector, every economy. In the past, because of certain crashes, there were no job losses like we have today. Interestingly, I read a survey which says that India's unemployment rate is 22%. What it effectively means is between every 5 people, one is unemployed. It is serious. Between every 5 people, one person is unemployed. That is what the statistics are indicative of. It is also clearly said that NASSCOM says that startups are running out of cash. Within the next 3 months, you will have a fleet of businesses filing for bankruptcy, which is already starting to happen in America. Bath and Body Works, Victoria's Secrets, you name the high-flying retail stores which were once high-flying, they have all started to say that we are getting into trouble and they are shutting stores across. We are recently also reading about various companies. Ola sacking 1,500 people, and the unemployment is just continuously rising. Am I audible to everyone? Because I heard no response. Deven bhai, can you hear me?
Yeah, you're audible.
Okay.
You're audible.
Okay, that's good. Also very important to say that earlier in the crisis, when the crisis used to happen, there is one particular factor in the economy. If you shift that, everything else changes, which is interest rates. Interest rates are something which are drivers of liquidity. What we understand by interest rates is when interest rates rises, things become expensive, hence they fall. When interest rate falls, things become a little cheap, cost of capital becomes little cheap, hence it boosts business sentiments. Now, what has happened in 2008 is super. In 2008, governments all across the world, when we had a subprime crisis, did something called quantitative easing. It sounds very high-flying, but effectively what quantitative easing means is they bought public debt and made it government debt because there was no liquidity. Effectively, the government gave the money and made the entire private debt to government debt. So private sector people got the money, and hence the whole chain of things, the engine started for the economy. This they could do by controlling interest rates. They would make sure the interest rates fell. Today, the problem is the interest rates are near zero anyway. The interest rates are no longer as high as they used to be. interest rates are either closer to zero and in some cases negative. So the government, which earlier had all the power to control things using the interest rate, have now exhausted everything. What does it also mean is US, just to make sure that the economy props up and it doesn't collapse, they have started to buy everything. Public debt, they are starting to buy corporate bonds, they are starting to buy just about everything that you can throw at them, and they are pumping in trillions of dollars. Today, as we speak, the government balance sheet is 7 trillion, which is enormous. It is historic. So, should things not improve with all these concentrated efforts by all central banks in the world, we are going to be facing an even deeper crisis. Remember, the stock markets are a reflection of how an economy performs, is what I read in college. But it always is not necessary. It may have a lead lag effect, which effectively means that things can become different for a little while because there's a change in sentiment. When our prime minister said that he's going to give a boost up stimulus of 20 lakh crores, everybody said, yay, yay, yay. Markets went up for a few days. And then we all realized that there was really no boost up. It was a particular stimulus that didn't really help much. I wouldn't say it was useless, but didn't help the situation as required. Deven, over to you.
No, you are finished. I think thank you, Regan. Virtually what you put across. And first of all, I would like to thank the Hinduja College to allow us to speak on this thing. And it's very tough on a Saturday afternoon. And now after lockdown, people are used to afternoon sleep. And it's very tough to stimulate people to listen to us. It's like a match which is going for a draw, and no, not even the fielding side, nor the batting side who are in the pavilion are interested about the match, except the batsman who wants to personally score a century to prove himself to win the next match, to be in the next match team. So it's a very tough thing. What I'm coming to is basically the things are not as gloomy as what we think. Is basically for a number of years I have a reason, like recently as Regan has put across that stimulus packages will come. Suddenly, there will be a lot of economists and everybody are putting across to. Can I move my slides, please? Yeah. Suddenly, you will see that the public debt to the GDP is going up, like spiraling down, up. And if you see countries like Japan, Greece, US is around 99%. Recent figure is as close as 99%. Britain is around 99%. And it's people will say it's a worrisome because government is borrowing is as good as compared to GDP. But the concept of 2008, where Ben Bernanke came with the helicopter money concept, that government is going to pump in the money into the system and stimulate the economy, and that is going to happen. Presently, there are stimulus packages being announced everywhere, and similarly, subsequently, the helicopter money also will come in. So, but yeah, there is some problem. Like sure. Yeah. So I now it's okay. What happened? What's going on? Excuse me. Can anybody hear me? I'm not getting any response. You're off or what? Yeah.
Even by Shushipra says that he can hear you perfectly, so I believe the rest of them also can hear you.
Okay, so coming to basically, if you see historically, and there are two prominent countries which have a very strong financial markets. If you see historically, from 1700, Britain has always borrowed number of times, more than 150% or 100% of their public debt is more than their GDP. So what does it show? That basically it's that very simple that government intervenes when the private sector, and both are the promoters of private entrepreneurs in the world. So what does government actually do when the private entrepreneurs are not able to buckle up the economy? The government intervenes it, and that has happened number of times. If you see the years, government borrowings, though there are some figures somewhere you will see they were near the world wars also, where the government has borrowed more than their GDP. Okay, but this normally happens, and as uh, Regan has said that the market might, they are only 40% expected furthermore downwards, but there are always opportunities, and especially in debt. Before I start about what instruments and why, I would say that remember one thing. I have a very simple philosophy in investment. You marry once in life, but you do not marry your investments, and investments have to be churned. And let us accept, like in specifically in debt, where the government is going to intervene and bring the interest rates down, and the corporates are going to get the benefits of it. This also gives a downward benefit of trading into debt papers. And similarly, virtually when you're at a zero interest rate, virtually zero interest rate, capital formation is far easier, or availability of capital is far easier. If you see today, last week, when people are saying that we had a problem with the China, we had a problem with all figures are not going to be good and everything, and suddenly the economy was Sensex was going up, and a lot of people said that this is a steroid economics or whatever they call it. But the truth is lies is basically that every market gives opportunity, up or down, and especially in debt, it always gives it. If you see the traditionally the real interest rates in India started actually after uh, 92, when the RBI said we will not intervene in the market and the market factors will control the interest rates. And from 12.26%, it's now today we are at 5.65. And this is virtually and every time if you see once the market comes around the interest rates are really rock bottom. So what the government has done today is that very simple, interest rates have been brought down. The corporates will have a lot of easy, and a lot of these benefits will be coming back to the corporates and individuals on a lot of things, and subsequently housing loans, individual EMI payments, and all those things will be becoming far more cheaper. I personally believe that to stimulate the interest rates will have to further come down. I think Regan can correct it. Regan, do you see 4.86 coming in?
It appears that it will.
Okay, so it will be the 4.86 had come when we were at 2008 2009. Similarly, we were in 2003 when our economy was not growing faster, and Reserve Bank had to intervene and keep on cutting the interest rates. Basically, the gain, if you see from 2000 to 2004, in subsequently nearly 4 years, interest rates went down from 11.7 to 4.9. It's subsequently around 7%. And if you see in that 4 years, if you see all the mutual funds, if you compare that 4 years in debt funds, they had a phenomenal returns. Phenomenal returns means basically they are somewhere they had given returns of 14% to 15% in a year. Similar thing happened in a shorter time, because in 2008 2009, where the interest rate from 9.46 fall nearly 5%, they fall down in a drastic way within a couple of months. Same thing has happened this time, but it's in a very gradual way from 2018 to 2020. Yes, a lot of people will say that we lost money in that mutual funds because of not good quality paper. That is credit risk, which mutual funds have to do it on their own. Markets can't support that. Credit risk is always a fund strain. Correct me if I'm wrong anywhere. This is the Sensex. Basically, I don't want to say it has been phenomenally from 1980, so it has outperformed all throughout. And let us accept from 1980 to till today, the markets have got consistently some crises have been kept on coming, correcting and improving and not. And this is something which I always believe is a gospel thing. And this shows how these are the charts of 10-year GSEX and Sensex. And if you see, moment the markets fall, the interest rates start falling. The interest rates have been corrected by the central bank. Intervention of central bank comes in, walks in, and stimulously when the interest rates are at rock bottom, and when it starts rising, the market starts rising. Why do they rise? One, when the money becomes cheap, it also becomes asset class become whereas the asset class are limited, it always creates an inflation. And for growth of any economy, we require inflation. If India has to grow by 9%, we have to have inflation between 5.5% to 6%. So cheap money brings in inflation. Like I have always said, the best export Americans did, US of United States of America did in last 10 years was inflation by pumping money into the system on regular times and intervening in everything. So if you see this whole chart, whenever the markets fall, so basically when we were taught economics, interest rate should be bottom when the Sensex should be up. But if you see here on this chart, it's virtually that interest rates are down as the markets go down, and when the interest rates go up, because the inflation is required, and to when the inflation goes up, when the asset class inflation goes a little bit hyper, and central bank intervention comes, and they start hiking up the interest rates. So if you see the peak of the market is when the peak of the interest rates also is there. So this is something which is very phenomenal in markets, which I have seen that in last 20 years or 25 years, whatever I learned in economics, and most of you who are listening to me were not born also. We saw that we were taught that the interest rates have to be bottom when the Sensex are to, I mean, the equity market has to be top. But that is not a true thing because both work simultaneously and their advantages come both the sides. So normally, when I always believe, when you believe that equity is going to go down, that is a right hedge for you to invest in. And when interest rates start rising, that is a time, it's an indication that you should move into equity. As Regan has said, at the bottom might not be there. So then you should be in debt. And if you think that because of the technology, markets have become much more faster, information passing is faster, and markets have become very, very fast. So then basically, I would say if anybody wants to invest in debt, don't look at a long-term paper, look at a short-term papers, be placed that my money is safe. I would look at treasury bills, not more than 180 days to 150 days to 180 days, not more than 200 days, because I personally believe that it's safe and the money 100% safe because the government is the safest place to keep your money. But what we will see is this is also a fantastic chart when to enter into equity market. If you see this chart is a market P, and if you see the market P, whenever it touches 28, it collapses. Every time 28, 28, moment it reaches 28, it collapses. Presently, the market is placed at 25. So we are not at an investable grade. We should be better be away from this market, be in cash, go into debt, government securities, and those things. Keep your money live, and opportunity will come in. I I think ups and downs are part of the markets, and let us accept that there is no way that you can keep on investing in one category and ensure a positive return. So you have to have the both the categories in place. I'm open for any question. Anybody wants any question? I hope. Sushpriya, I can hear you.
Now, I would like to introduce our course coordinator, Mrs. Mrunalini Shingare ma'am, who would like to introduce you.
Yes, hello, one and all. Good afternoon to one and all. Thank you, Deven sir, for joining us. I'm the course coordinator on behalf of BIM and on behalf of our college, K.P.B. Hinduja College of Commerce. We welcome you for such a enriched knowledge, specifically when you are mentioning about the debt and stock market, especially in today's COVID situation. Without wasting any time, Sushubra, just we'll ask Regan sir also to join for the same. Thank you.
Yes, Sam, I can hear you.
Hello.
Yeah.
Hello.
Finally,
Yes,
we have given short brief of presentation on that. We have already
Yes.
given short brief.
Yeah, Sushubra.
Yes, ma'am.
Yeah. So we'll wait for Regan,
So,
sir.
yes,
ma'am,
I
actually, sir's camera is not working right now. So, sir will only be talking.
Yeah, fine.
Sir's video is not visible. So, are we going to take up questions right now?
surely
yes, we can.
we can
So,
take it.
people who are attending the live streams, we are taking questions at the live stream right now. So, you can just put up your questions in the chats and we will display your questions on our screen.
I told you it's very tough on the afternoon time to get questions also. Was fast? Was I fast? You can understand. There are no questions, I think so.
We probably have explained the topic very well.
Maybe it is other way around also.
Yeah.
Okay. That is yours.
Sorry, the question is, as I read, is BPCL reported a 99% of loss and still the share price is increasing. What is happening? Maybe people expected worse, and 99% is only a drop in profits compared to a particular period. It's not an actual total loss of 99%. So please understand the difference. More importantly, BPCL, HPCL, any government entity these days is very, very looked upon. The reason why they are looked upon is their revenues are definitely going to come because the government is going to pay. There is a huge part of safety when you're dealing with a government, and there is a huge part of no safety as well. But in these cases where there is a pandemic, everything is trying to be normalized, the government will get their dues. So BPCL has no problem per se. BPCL, HPCL, IOC all have fallen dramatically and pulled up as well. But that's all there is to it. And just by the way, in spite of BPCL going up, it is still 40% off peak values or maybe more.
Something to add
Lokesh,
more.
have I answered?
Something to add more on Regan. There is an intrinsic story, and believing what the present government is, and there is a huge disinvestment story. Today, BPCL or HPCL, they will be the first in the line for disinvestment also. So there is a huge story inside there also. Maybe which a lot of people are looking at the market side that it will be and at this price, government will not come at this price to disinvest. It will always look at a higher price. It is worth holding this prices at this place. So there is a huge underlying story also. And similarly, I am expecting on the banking sector, because if the government has the amount of debt which the government is going to borrow and run the economy, I think disinvestment is going to be the only one of the way of solution on the future. Regan, correct me if I am wrong what I am saying.
No, that's perfectly fine. That is true.
So the government will have a huge disinvestment plan next year. Today, I personally believe the shares with P of 5 or 6, 7. What is the P of BHEL, Regan?
I'll have to check that, but it has to be much under control than what it used to be.
So around 5,
I'm
6,
gonna
5, not more than 5 or 6 or 7. Yeah. So if
It
you
could
see,
not have been because the prices have fallen so dramatically in BHEL. Once it used to be a 350 rupee stock or maybe 550 rupee stock, and it's now what, 30 rupees? So
yeah,
effectively, the price has continuously come down, but that ratios don't matter there because the PE basically has to be supported by
earning.
earnings.
So what I see is that basically a lot of, even let us say compare nationalized banks PE against the private banks, leave us at HDFCs or those things. But if you see the market values of those other private banks which are listed, the nationalized banks PEs are sometimes half the value. So today, I personally believe if I want to be safe at these prices, I would look at nationalized banks or PSU banks to be at a safer side. Any questions, more? Regan?
Yeah, I think it is one of the sectors that everybody is going to look at very closely. There are two reasons for it. Just remember, today when you look at just very commonsensical, today if I have a wife or a daughter or something to that effect, I would not want my wife to use public transport. I would not even want my daughter or any of my children, if they have to go to college far away, to use a train. This gives rise to either buying them a vehicle which is new or buying them a vehicle which may be second hand, so to speak, or maybe pre-owned as they call it. So effectively, there will be a spike in auto sales at some point or the other when this work from home system is going to reduce or go away. Currently, we are all at a work from home system, and which is why we don't have a problem. But as soon as things begin to normalize, and there will be a time when the system will start to go away slowly but steadily and surely, at that time we will have a system where people will have to go back to work.
Regan, I think the financial markets should not have work from home. I think they were allowed to work.
They are
So that,
allowed to work, but it is only on essential services. So, but here we are talking about the market on a whole.
sure. No, correct me, Regan. There are a couple of things. As a stimulus package is more focused towards infrastructure, I think the demand for the commercial vehicles are going to go up. So there will be a take maybe as we say from. I think the recovery will start from September, October onwards. Suddenly we'll have some figures coming in commercial vehicles because infrastructure projects and everything, where the government will focus to improve the economy. So commercial vehicle take is going to be high. I think suddenly we'll start moving upwards, which was very bad before the lockdown coming in. So I think those things will be started coming in. So I think auto sector will be having some positive moves.
Deven, I'll give you a small example since people like to talk about stocks here.
Yeah.
Uh, in May, Maruti reported a sales figure of zero. Okay. And the stock price went from 4,000 to near 6,000 now. It is bizarre that the stock was 50% up at a time where the sales figures are reported zero or negligible to what they used to. So when we put logic in stock market, they sometimes don't go together.
But Regan, here I want to correct it. The stock price, today's price is not for today, it's for future.
Correct. So they are
Okay.
discounting the future.
So we basically, and always it's that way. So honestly, what you're investing is not, you have to see your horizon. Like if I see my 2 months horizon, then I will invest in a stock at 6,000. It looks very bad. But if I see a 2 years down the road horizon, then somebody is looking at a very good price.
Correct.
So, and what was the peak of today? Also, it is 30% lower than what was the peak of Maruti.
40% lower because Maruti was 10,000 rupees on the peak 2 years ago, and today it's 5,900.
Second thing, so a lot of things do change. Today, also the valuation point of view, Maruti looks fantastic.
It does.
Okay, so the market is always looking at future, not at present. When you talk about present, then you will never get any return because present is already been discounted in past.
Correct.
So that is one of the reasons why people do. Every time, whenever I say that I'm an investment banker, and I have to add that we create disasters, and that is one of the reasons we say that because people always talk about abhi kya dekho kuch ho raha nahi hai. Now, if you're locked down for 2 months, I personally believe nobody is going to give you a fantastic balance sheet in this month. But what I'm looking at is valuation point of view, the companies what they look at around a year back, a year forward, and what they were a year back. Let us discount both the things. Let us discount the 1 year scenario and see both the sides, and you'll see that the valuation point of view, some stocks are looking really good, stock wise. Market looks overvalued. That's true. Regan, should I take this question?
I could take it up if you want me to. I'd give a general.
Because normally the debt guys come behind only because equity is always everybody fancies, and normally it's mostly stimulation for every youngster, and thank God nobody takes debt. So people like us can continue in this market for next 2-3 decades more. So
Yeah.
please you take it up.
Okay, so it's a very clear thing that housing sector is going to be under some serious stress. The housing market was not moving even before pre-COVID. Things had become way too expensive and things had become way too hyped up. All the fancy luxury projects were any which way not selling. After COVID, what has happened is now you have a whole stream of workers that have gone to their own homeland. And now labor is going to become that much more expensive. Does that mean that the housing prices will further rise? Not at all. There are people who are working on borrowed money. The banks are going to go after that borrowed money. So once that starts to go after the borrowed money, people have to desperately sell off inventory, which is going to result in a very steep cut on prices. If you go to find out a house today, what was available for 5 crores in January can be bought today at 3.5 or maybe 325. So that's the kind of deterioration the housing market has had. If you ask me, is it the best time to buy a house? Absolutely the best time to buy a house. But I don't know how many people have 3.25 crores or 3.5 crores lying in spare. So, and at the same time, you have an unemployment risk today. The best thing that has happened to all you students is that you are still in college. It's the best thing that could have happened. So while you are in college, it will take you another 2 years to get your MBAs. It is the best time because after 2 years, the whole scenario will be so nice and rosy because every destruction that needed to happen is done and over with. So thankfully, it is the best thing that any one of you could go through today. That you are best in college, please study very hard. And this housing sector, yes, is very affected and is going to continue to get affected. And today, builders are working on wafer thin margins. So you might find that certain builders are also going bankrupt very shortly, which means the inventory will come to the market to sell because the banks will obviously take away the housing on which the money has been borrowed as collateral. Deven, over to you.
Yeah, first, before housing sector, I personally believe that housing sector is going to affect the NBFCs very badly. The NBFCs have been very heavily invested in housing sector, so that is going to be like if you are taking buying a debt of NBFC, please be watchful. What is their portfolio and how much is the exposure to housing industry? I personally believe housing industry is going for a sea change. Personally, for a sea change because India is a young country. Presently the houses are being basically we are not addressing to the young crowd and affordability of young people to buy the house. So what I have a belief that not affordable housing, but there is sustainable housing will be coming in. Condoms, those type of concepts. Though we in Gurgaon and everybody were using these concepts, but they were not affordable for a youngster if he's 26, 27. From his salary to pay the EMI or a rent was not an easy thing to today for youngsters. So I think we need to see change, and also the government will have to relook at it because housing industry was one of the heavily taxed industry also. If you see the stamp record, stamp paper, stamp duties, transaction cost, we say also on the under floor space in index, we say for additional floor space, it was basically they brought the ready reckoner rate to such a high level that today virtually in Bombay, any new project, at least up to say Borivali, if I buy extra FSI, it's not worth constructing. So the government will also have to understand that this industry can't be heavily their revenue generation can't happen. And let us accept if today MMRDA or MHADA has such a high cash which is coming from the housing industry. Where are they getting this money from? If I buy a land for 5,000 crores or 3,000 crores, and where will I create it? Who will buy that land and who's going to create what type of job I'll go to create there? I'm going to create there. So those all things will be in correction. So I personally believe that a new concept will come, which will be targeting towards youngsters, which will call a sustainable housing, which will be coming in shortly in a new concept, basically where it will be on rental. And I think the rentals will have to grow up because today rentals are only 1% or 2% in housing industry. So you'll have to bring the cost down, subsequently bringing new technology into it and a lot of things, and bring your rentals up. So basically, you have rates and everything can be used in the market because your rentals are hardly 2% of the principal. So it's worse than a fixed deposit. So it's artificially real estate was artificially up. Regan, up to you. Anything else?
No, nothing else.
I think the next question was how much is a PE? No, there was one more question. I think from Ms. Doshi about the PE of the markets. How much PE is important? I think Regan, you would like to answer that, or I'll answer it later.
Sorry, what was the question?
How much is the PE important for the market? There was one question like that.
It is very important to the market because it indicates what the earnings are and where the markets are positioned. If the earnings don't support the market, then it becomes higher PE, which means that the markets are expensive and they need to correct and they need to come in line with the earnings of the market. At the same time, if the earnings are very high and the markets are low, it means the market is cheap and the markets are likely to rise. This is the basic concept of a PE. What is also very important when you look at PE is that it's not the only thing to look at, but an important parameter to look at when you're gauging the Sensex or the Nifty or any index. Because any and every index, when the world looks at it, because India is looked at by the world, they will look at the PE ratio for sure. Hence, PE becomes important here.
It's something to add.
Deven, back to you.
Yeah, something to add on what Regan said. See, market PEs are indicatives, but when you see stock wise, now supposing Amazon is going about 110 plus P, because Amazon was a business concept which came in the market. If you see HDFC was, so any given time, Regan, correct me, was 35 to 40 when the HDFC concept of private banks coming into the system and everything. So it depends
Yes.
where when you see a stock and what they are actually that company is. If it's a growth story, now let us accept Amazon is 110 plus P,
So
and
quality always comes expensive.
quality comes section. Second thing is that a new business is coming in. The valuations are Amazon is just make profits for last 3-4 years comparatively. If you see PEs of Microsoft or Apple and everything are in 30s and 40s. So is Microsoft why Amazon has been it's very costly. Everybody will believe that, but Amazon's actually real profits are going to come. And let us accept every second Amazon is doing I think two transactions a day. I mean say every second. So it's a growing business. So the valuations are going to be. So you have to understand the business. If you are looking at a company PE, you have to look at the business. If it's a growing business, let us accept that Uber. Uh, when the valuation came, people said, when will they make profits? Okay, and when they got listed. So it is a growing business. Then the PEs might not be determined. The business is important, and more important, the management is important. When you are looking at a growing concept or a growing business, that is more important than the PE. Uh, Regan, back to you about the next question.
Everything depends on future earnings. So if the earnings potential is high, then obviously things will look extremely good.
Regan, why don't you answer the volatility? Does the volatility in the market in such bearish market will either boost the market or either make the movement slower? Regan, can you answer this? Regan, are you there? Uh, Regan is not there. I uh, I personally differ. Basically, the volatility in the market is always going to be there, and with the technology coming, the information passing very fast, the cycles will be shorter. So first, we used to always call when I was learning in my college. My grandfather used to say that every 10 years the markets go downwards phase, and every 10 years there is a cycle. By the time I passed out of college, the cycles became 7 years. If you see the Black Tuesday and subsequently 96 crisis of ASEAN countries, then dot coms, then again this thing. Then it came the subprime and then Greece issue, the European Union issue. Because
Hello.
yeah, yeah,
The questions reach
you are
fast.
able to hear now, Regan. Okay, so the cycles are because of the technology and the information passing seamlessly. I think the volatility will be there high in the market. I don't see the markets being slower. Markets will be much faster, and it will be. I would like to say that in cricketing terms, I will put it across that you will be playing on Australian wickets or English wickets where the ball will be coming fast at you. Either you play it or you get your wicket out. So basically, it's going to be not bearish or a slower market. It's going to be fast, and opportunities will have to be taken aggressively if you are looking at it. You can't wait for opportunities in this type of markets. Regan, your comments, please.
Hello.
Regan, can you hear us?
Yes, I can hear you now.
Can you answer this because I have answered it? You heard about me or no?
So there was some connectivity issue, but I'll answer it for what it is.
Hmm.
So first and foremost, the volatility of the market is dependent on how things unravel before us. So the volatility generally is of late we've been having volatility because of huge FII numbers that are coming in. Either FIIs are pulling in a lot of money, pulling out a lot of money, or pushing in a lot of money. please realize one thing, and this is something that a lot of people don't, so might as well pay attention to this. When the market started to collapse since end of January, a lot of people said that FIIs pulled out the money. But if you look at the data, the FIIs pulled out the money from equities and invested in debt. Because the reason I say this is because your forex was still steady. Your US dollar and your Indian rupee was still steady. You were still between 74 and 75 and 76. This is what you've been trading in. If there was a true pullout of the FII money, then your USD INR would have gone to 80 rupees to a dollar. So effectively, the money has churned between equity and debt. The volatility is largely because of that. At some point, this trade will reverse, where Indian equities will start to look better. Now, I don't know whether the Indian equities is going to start looking better to FIIs at 25,000 or 21,000. But at that time, when it comes 25,000 on the index, on the Sensex, I would suggest that everybody should just put in whatever money they can find from anywhere that they can find into equities. Because on a 7-year time frame, equities have always outperformed debt every single time. Whether you go back 100 years and check that, you go back recently, on a 7-year time frame, whenever equities have done badly, it has always outperformed debt in a massive, massive way. So volatility is here to stay. Volatility is not going anywhere.
And honestly, as Regan's projection goes on interest rates, Regan is a technical research basically guy. So if Regan's has been saying that interest rates at 560 and 490 is reality, I think one of the indicators you have to also see when the interest rates are really at 490 or those areas, and see your Sensex where it stands. And I think this will be indicators for you to move into the market. Volatility, if there is no volatility in the market, markets will not become anytime slower. I think the technology and the information passing is so fast that I think markets are going to be faster and faster, and opportunities will come faster, but it will have to be encashed at the right time. You have to hit the ball at the right time, or you will be caught in somewhere in slips or gullies. Any questions? There was one question again. Okay.
I'll take up this question, Deven Bhai.
Yeah, you take and then I'll add on it.
Okay, so it's a very simple yet a very complicated question because it involves a lot of parameters. As far as time taken for any economy to bounce back, if you look at historically, we generally don't take too much time, maybe 2 years to 2.5 years maximum to bounce back. So it is very, very important for you to understand that any crisis that have come in India, as far as the stock markets are concerned, have lasted for 2.5 years. Thereafter, it goes back to the peak and does all sorts of mumbo jumbo there. As far as issues are concerned of lower demand and all of that, people need to again get back into the security of a job. Today, people don't have job security, which is why their spending is very, very calculated. There was a time when I would want to dine at a, let's say, 5-star hotel, and I wouldn't think twice. Chalni ya Devan used to say. Today, we might not want to do that. We might want to be a little calculated with the money. Even if your parents be a little calculated with the money, which means slowing of demand. Awareness of consumers come from there. So low spending effectively, if everybody tries to do that on a collective ground, you're low supply after this. So basically, you're controlling supply and you're controlling demand. Now, to answer the question, why is the Sensex at such high levels? It is largely a liquidity governed rush. Today, you have the Ambanis hypothetically coming up with something absolutely stellar, wherein they've managed to raise 1.5 crore in a time where people are desperate for survival. So he's gone and done something which is extraordinary and has managed to raise money and managed to take the debt off the books, which is completely different, and it's a one-off. That is why he is one in Asia, which stands among the top 10 in the world. So please understand that that's a one-off. The rest of the market is actually trying to survive this crisis. And eventually, if NASCOM, what I told you, the predictions are right, half your startups will die. The startups won't have enough money to survive unless and until there is clarity from the government that they are going to do an infusion of money and the interest rates remain low. Startups won't even come up because cost of capital for startups will be very, very high. And plus, startups have what collateral? Zero. They are all unsecured people. So please understand, this is why the markets will have to follow logic at some point, and they may correct very significantly.
Regan, you're over, or should add something? Regan?
Yes, please go ahead, Deven sir.
See, Mithun,
Yes, sir.
yeah, Mithun, lot of people will talk. There is recovery will be V, somebody will say U, somebody will say W. But whatever I have seen in last 2.5 decades and more, the recovery is V. Mostly it's V. It goes fast. We are on the first angle. We are only midway. I think the bottom is yet not to come. I personally believe that. But the bounce back also will be in a very startling way. Okay. Spending, I personally believe this Diwali, people will say not as good as from 2000. Honestly, normally when we do corporate giftings and everything, and I always used to talk to the corporate gifting guy, and I used to always ask him when I was giving corporate gifts on behalf of my company, and I always ask them this question: how is this Diwali? And say not as good as 5 years back, but it's okay. In last 20 years, this gentleman has opened 7 shops and he's doing phenomenally well. But if this Diwali also I'll ask him, it is not as good as 3 years back, but it's okay. That is the way it works on. So it's a lot of logically, because if you are at home for nearly 60 days, 90 days, nobody knows what is happening. And initially people thought it was a paid holiday, and suddenly now the corporates have started sending letters that, boss, you will not get 50% of your salaries are going to be postponed. This is going to be, it's created a knee-jerk reaction. I think the whole thing unraveling will happen somewhere in September, October, and actual impact of the system will be able to come to know. But I personally believe consumer spending, you can't. I hope you will not stop using toothpastes and brushes and your toiletries and everything. So in this that market like Hindustan Lever and ITC, and they'll keep on doing it. Yes, luxury goods will have a damage. Yes, 5 stars will have a damage. But yeah, people like me will be having a better steel deals, because today we will have a better steel deals. Your maybe 6 months down the road when the travel becomes easier, abroad traveling, you will be getting a far better deals and everything, and that will stimulate the systems everywhere. Tourism industry will be having some music. Some industry specific will happen, but overall things will be only after September, October. We'll come to know what actually impact has come about this thing coming to use. Any more questions? Uh, what is the nearest market outlook for corporate debt markets for funding infrastructure projects? Uh, Infrastructure projects, yes, so government support is going to be there, but I would like to say that in the problem with the infrastructure funding is going to be better. You should go through, if you are investing as a investor, then you should go through the government infrastructure company funding companies like IFCL or those type of companies instead of going to the private infrastructure companies because their balance sheets are little bit overstretched, and I would look at uh, avoiding private sector infrastructure companies. I would like look at infrastructure companies like PFC, RAC, IFCL, Indian Infrastructure Company Limited, government promoted infrastructure funding companies instead of looking at this. And there is some juice in that side, but I don't know infrastructure companies will fit in the long term, because if the interest rates are going to bounce back at one stage, then they are normally a long dated bonds. So as an investor, I would not like to look at infrastructure bonds as a small investor. As a corporate investor, I will look like it. Uh, what is Regan? Would you like to add something on that? Regan?
No, Deven sir, I think you said it very right. You have and people who are in.
The next question, please, if anybody has got
So
it.
PFC, RAC are very, very important. NHAI and all of those category people. You
Yeah,
should avoid private intervention there,
yeah,
unless the balance sheet is of a size and technical abilities match.
yeah. Honestly, I think even not, I would not like to touch the best of the blue chips in the infrastructure companies today in private sector, because their balance sheets are overstretched. They have long previous pain still is there in the books. Next question, please. Regan,
By the way,
your
RBI also gives dividends, huh? So just remember that. So RBI also gives dividend to the government, and which is why the government can go and borrow money from the RBI. So this dividend paying companies are generally never given the rating that a non-dividend company that invests their money in themselves. So quite honestly, all these companies which have never not given dividends, they have also not gone ballistic like the rest of the private sectors have. So as far as letting the cash go out of the system, their dividends have also reduced dramatically. Their payouts have also reduced dramatically, and so have the prices of those stocks.
Regan, here I want to correct it, because dividend paying also, let us accept that there is a shareholder who has taken a huge risk and invested in the company. I think when in an economy where you do not see expansion and little bit contraction, why should not I pay dividend? Why should I sit on the cash and keep on expanding when I think my optimal utility is good enough to service my industry for next 2 3 years? Regan, any inputs on my what I've said? Because why should a shareholder not suffer if I'm making
See,
cash?
Deven bhai, it depends on what. Sorry, what did you say the last part? Why should the shareholders?
Shareholders always look at some future market earnings when the company is sitting on cash, and when there's a bleak situation in the market and expansion doesn't
No,
bring
no.
me a
I'll tell you
revenue.
what happens.
Yeah.
So I'll tell you what happens. When companies keep paying dividend and are very handsomely paying dividends, today for the same dividend payout, payout ratio will look very, very high because the prices of the stocks have So even if a company pays less dividend and maintains the dividend payout ratio, the output that it gives to the shareholders is substantially lesser. What is also very important to understand is these companies generally PSUs and do not hold cash.
Regan, one thing I request
They
you.
do not hold cash in any case. unless and unless you are talking about a private paper.
Regan, I know you have been recommending Reliance a lot, but I think you should take a Geo in your house. Huh?
Okay.
So because it's a very important thing, and something which we I'm adding to what Regan said about Reliance story. I think a lot of good corporates in India are going to follow this, that they will become debt free shortly, and suddenly you will have some corporates who have a very bad ratings will suddenly bounce back. Just to add you that there was a live case that was one nationalized bank had a triple B rating and suddenly in one night became double A minus. So these are the opportunities that are coming in debt markets also. And suddenly you'll have some corporates who will really clean off their debt and come out with this model basically because there is always a followers to the leader and Reliance is a leader and shortly you'll see a lot of corporates looking at this. They're removing their debt out of their books and getting in the capital for their businesses and everything. So this is one of my views.
Deven bhai, the one that you mentioned about the rating changed overnight, we are
Yeah,
talking about Indian Bank, right?
Indian Bank. Yeah,
Yes. So Indian Bank today, people who don't want to look at will suddenly start looking at because the ratings have changed. There is more safety because of the ratings. So suddenly liquidity and volatility both will rise there. So just so that everybody understands that, please.
surely. Sorry. Yeah. Any more questions?
Are there any more questions that we can take up? Currently, the best schemes and funds that are there in the market are the large cap schemes and funds. It is very important to stick to the leader. The reason why I say stick to the leader is because the leader will have the technical ability and the balance sheet to support business, which small businesses or mid-sized businesses may not have. So if today somebody wants to invest in the stock market, given the volatility, given the uncertainty, given the stressful times, it is very critical that you stick to large businesses, and hence the top 100 companies is what you should be looking at and not going any below that. So my understanding is you should look at something like an HDFC top 100 or an SBI blue chip. So very, very important schemes. And you should not look at the mid-size or the small cap names at all. Look at the large caps, look at leaders. Deven bhai,
Com-
over to you.
Coming to debt markets, I will be very clear that before selecting schemes, I would like to say very clearly see the funds credit risk management because one of the principle which the mutual funds have really badly managed in corporate papers is very corporate debt paper is basically the risk which they took for the additional 5 basis point or 6 basis point, and that is something which beforehand we will look at it. I would not look at corporate bond papers in any of my mutual fund which I buy as of now. I would stick to a fund which is only investing in government papers, which is very hard and very tough to get. So I would like to avoid mutual funds in these scenarios in looking at corporate papers because I have been literally been uh, they somewhere their credit risk management was really bad show. If I it's totally I will not mince any word for that because if you give negative return on a liquid papers, which is horizon not more than 30 to 60 days, and you give a negative return, this shows that you have no capability of judging a quality of a credit paper. So I would like to avoid in that any mutual funds out of this whole scenario. except they have a 100% government securities, 19% government securities, then I would like to look at it, because then I'm taking only interest rate fluctuation as my risk. But today, at a corporate risk, corporate debt risk, I have doubts on the most of the mutual funds.
Next question, please.
Some question came, but I think we were talking on this only. Regan?
Yes. I think this particular question is largely covered with what we've spoken. Because of uncertain times and because of uncertainty and because of reduced business or businesses, the corporate earnings obviously have had a battering. They have reduced very significantly, which is why you've had a sensible fall in tune of 40%. Effectively, if those earnings, corporate earnings, don't come back anytime shortly, you will find the markets getting depressed over a period of time. So corporate earnings are obviously dampened as we speak.
Yeah, thank you, Regan. Yeah, corporate earnings next 6 months are looking very bad, and then it depends how global, like now presently G7 meetings and all this are coming up. How we stimulate the economy, that is going to be a role, and this time the countries have to play the sovereigns have to play a major role to revive the economy, because something which was not in hands of the corporates or not in the hand of the common man, it was in hands of basically. So we'll have to we'll have to see how the sovereign people, I mean the countries, when the governments are going to play their role to revive the economy, and this is going to be very challenging for the governments. And I personally believe that US will be first to jump, because the elections are coming up in November. So US will be the first person to jump on, because they can't afford to have a economy slowing down, because the figures in May have been coming out very well at a very huge risk. I know they have taken a very huge risk on the uh, do's and don't do's of COVID, and they have given a lot of liberties for this thing at a very huge risk, and they are paying a huge price for that. So it depends how the countries now stimulate the economy, because this is beyond corporate. We are in a problem which is, I can say that it's like a small mini world war. It's a whole world has been involved. Uh, our generation, maybe my father's generation, we had not seen a world war, impact of a world war in a economy, and this is like a world war, and a whole globe has been involved into this whole problem. So it's the governments have to play a very important role to revive the economy, and this is going to be a challenge for people who are running the government. So it's going to be a huge task for them, instead of corporates or we to say how do we to revive the economy. Regan, am I wrong on anything, or you think you need to add something?
No, that's what is happening today. Uncertain times have got corporate earnings really, really bashed out of shape, because the businesses have reduced. A lot of things are going wrong, which is why there is so much sacking and there is so much letting go of people. There is so much cutting of salaries. So that those things are very, very important to address. That corporate earnings are going down.
Regan, this question is basically, we both,
I think trading anything, Ajay.
we both are anti day trading, so
So
we are
to
both biased on it. So basically, Be fair and basically be logical because, okay.
So to answer this question, day trading is something that I don't endorse. The reason why I don't endorse day trading is that it's firstly way too fast to make any logical sense out of it. Secondly, I shouldn't be saying that trading is bad, but the fact of it is that it is not as profitable as you may want to think of it to be. So my answer to that is instead of doing day trading, take a view on the market and trade that view. So that is the only way you will ever make money. Have you ever heard a day trader becoming a billionaire? I don't think so. I haven't heard one. And even if there is one somewhere, it is so far and few in between. So, to my mind, day trading is something that you should never be indulging as a full time thing. It may just be something that you do as an add on to your already large job, but nothing that you should be doing as full time. And this highly fluid scenario on the stock market, first and foremost, there is no highly fluid thing which generally may not work because the VIX today is so high up that before you can actually finish saying Jack Robinson, the market would have turned on the absolute shorter time frame.
I To add on to Regan, I personally believe day trading in today's market where it's first on today's scenario, it doesn't make sense because you do not know what is actually thing. Second thing, how do you do day trading? What is your research background, or what is your what do you have information in the morning and evening? It's only somebody who's buying a stock or something like that. The company information is basically periodically on the quarterly results and everything. So on what basis you are trading on daily basis? On information on suspective that who's buying it and who's selling it. I personally, Regan, you can correct me if I'm wrong in because my
No, no,
equity
it's
market.
something that you should completely avoid, and believe it or not, it's not going to help you in the long run.
Sure.
That is not where money is made. That is not where wealth creation happens. For wealth creation, you need to understand that there is a period and time. Even babies take 9 months here.
So, believe, so I personally, I've never been support of day trading. Yes, I had my own broking house. Basically, it make money for me. It makes money for me because I have daily traders. I'll give them tips and everything. But those even research house will no research guy can say that buy today morning and evening you'll get 2 rupees or 3 rupees. Nobody can say out of 90 times 100. But I can tell you frankly, if you have a very good research house and they at least can give you 60 to 70% very good outlook on a corporate, a 2 years or 5 years horizon that this stock looks very good. So
To give
daily
you an example, to give you an example, how many people would actually think that Reliance for the next 3 years or 5 years is very, very good? But if you ask me, is Reliance good for tomorrow? I would have no answer. But if you ask me, is Reliance good for the next 2 years or 5 years? My answer would tend to be yes. Bharti Airtel, would the next 2 years be very good? The answer would tend to be yes. But with what will happen tomorrow, I don't think that that is more to do with luck and guessing, which I don't think you can base your entire career on. Next question, please. So it's a very interesting question. For whatever reason, if Trump loses, and the elections will, the campaigning will start from July onwards, and the elections are actually to be held in November, December. For whatever reason, if Trump loses the elections, then maybe the US markets will go into a dive. The reason why I say this is because Trump is very liked by the stock markets. He's a market man. He likes to doing things which are better and better for businesses. So effectively, if Trump goes out of purview, then there is going to be a huge problem that we'll see, and US markets will take a fall. As far as Trump opponents are concerned, they talk about taxing the rich by 90% and all of that. So I don't think the market is going to be very enthused with that. Deven
No,
Bhai,
yeah, I personally believe that a lot of people have, because we are seeing the ratings and everything. But unfortunately, I am also worried about the opponent to Trump. He's 75 plus, and how much he is going to in this COVID. He's going to be campaigning with the scenario. I don't think the scenario is going into September, and there are a lot of indication that yes, we might India if we play smartly. And this is a time where India can decouple itself. This is a time when globally people would like to decouple themselves from American markets if we are able to play it smartly. But yes, if Democrats win, Democrats have become more a socialist party than any socialist party available in Russia also. So we'll have a huge problems on that line, because uh, if Biden, the contender to Biden, what was his gentleman's name? Contender to Biden was the gentleman who was fighting it, was a hardcore socialist. Bernie Sanders.
Biden.
Bernie Sanders. He was a very hardcore socialist basically, and surprisingly, he was getting most of the youngsters' votes. So yes, we have a problem, but I would say that there are a lot of indications in this market that yes, there will be impact if US initially will have impact on markets. Yes, on geopolitical, I think zero, because geopolitically we are going to be we are becoming bigger partners to America on day by, and the recent conflict also makes us very long-term partner to Americans' ambition of keeping a check to the dragon. They want the elephant to sit on the dragon. So that's what on geopolitical is not a problem. Yes, markets are interconnected. We'll have the things, but there are a lot of indications. If somebody in 1967, during Johnson's time, when there was a huge violence on the streets for Vietnam and everything, and people would not expect Nixon to win the election, but and always violence has helped. Street violence has always helped the Republicans. Well, silent violence, silent protest has always helped the Democrats. So I do not see a lot of changes. This is my personal view, please, but I do not see. You might see presently the Trump scoring very badly because of COVID and his present handling of the racial thing, but Trump won on a silent voters, and silent voters were in middle of USA. They were not on the East Coast or the West Coast or on TV channels. So you have to understand that Trump never won, because I before the day an hour before the election vote started coming, the results started coming in. I think 90% of the world wanted Hillary to win. So Trump has got silent voters, and I personally believe that he might come back.
Okay, so due to time restraints, we won't be taking up any more questions. So now I would like to invite our course coordinator, Nunalini Shingare ma'am, to give you a vote of thanks.
Hello.
Yeah, we can hear you, man.
Hello. Thank you so much, Deven sir and Regan sir.
I hope you all enjoyed it. With our basic primitive knowledge, I hope you all enjoyed it.
Thank you so much, Deven and Regan sir, for enriching our knowledge on debt and stock market in today's COVID situation. And also big thanks to all the participants for attending our webinar. Hope all of you got good insight on debt and stock market. Thank you.
thank you too for having us on board. Thank you.
Thank you. Bye.
And also big thanks to all the participants for attending our webinar. Hope all of you
Thank you very much.
Thank you. Bye-bye.
Bye. And
Thank
Good
you.
luck to everybody.
Stay
Bye-bye.
safe. Stay safe. Thank you. Hello. Hello.